Most people think the silver market is one big number on a screen. Spot goes up, spot goes down, end of story. That's not how it works in the real world. The silver market can look tight and liquid at the exact same time, depending on which silver you're talking about. A 1 ounce 0.999 bar can move cleanly through the system. A bag of 90% dimes, or a cart of sterling flatware, can suddenly behave like it's radioactive. Same metal, different plumbing. So if you're watching price and assuming the physical market automatically follows, you're watching the wrong thing. Price is the headline. Flow is the story. And right now, the story isn't, is silver bullish? It's simpler and more uncomfortable. Can the market actually process what's showing up at the door? Can dealers turn yesterday's buybacks into usable inventory or even into cash on a normal timeline? Markets don't fear bad news. They fear what most people haven't noticed yet. Over the past several weeks, the silver market has shown a clear split between price behavior and physical processing capacity. On the price side, silver has remained volatile but active. Intraday moves of several percent have been common, with sharp reversals occurring within hours rather than days. Compared with the prior month, price swings have accelerated, even on sessions without major macroeconomic data releases. Liquidity in paper markets, futures and spot pricing, has remained intact, with continuous price discovery. At the physical level, however, conditions have changed. Dealers report strong retail interest in 0.999 fine silver products such as bars, rounds, and sovereign minted bullion coins. Certain products, particularly high recognition items like American Silver Eagles, have experienced rapid turnover. Inventory in these categories has been inconsistent, with restocking timelines extending compared with earlier in the year. In contrast, alloyed silver, including US 90% coinage, sterling silver flatware, jewelry, and mixed world silver, has faced processing delays. Refiners have continued to accept fine silver, but many have paused or limited intake of alloyed material. Where intake is still available, payment and price lock mechanisms have shifted. Settlement timelines that previously took days have stretched into multiple weeks, and some refiners now pool material before offering a lock price. As a result, dealers holding alloyed silver inventory have been unable to convert that metal into immediate liquidity. Material that would normally move quickly through the refining pipeline has accumulated on-site instead. Compared with last month, this represents a change in speed, not in ownership. Silver has not disappeared, it has slowed. At the same time, industry-wide data provides broader context. According to the Silver Institute, global silver demand exceeded supply in 2024, resulting in a market deficit. The Institute also projects another deficit in 2025. These figures describe aggregate supply-demand balances. They do not specify where silver is held or how easily it moves between forms. Taken together, the recent change is not a price shock, nor a collapse in demand. It is a logistical and timing shift, one that affects different segments of the silver market in different ways. What's happening matters not because of price, but because of friction. When alloyed silver stops moving smoothly through refiners, the first impact isn't felt by investors. It's felt by dealers. Cash flow tightens, inventory builds. Decisions that used to be routine, how much to buy, what to pay, how aggressively to restock, suddenly carry balance sheet risk. That's the first order effect. Liquidity stress at the dealer level. A shop that buys silver all day depends on turning yesterday's purchases into tomorrow's buying power. When that loop breaks, even temporarily, behavior changes. Bid prices get more conservative. Some products stop being bought altogether, not because demand vanished, but because the exit door narrowed. The second order effect shows up quietly. Retail availability becomes uneven. Fine silver products may still be visible in cases, while 90% coinage or sterling buybacks slow down or disappear from dealer quotes. To an outside observer, this can look like shortage in one place and oversupply in another, when it's actually the same metal stuck at different stages of processing. There's also a pricing consequence, but it's indirect. When dealers can't rely on timely settlement, they widen their safety margin. That can push retail buy prices for alloyed silver below spot, even while futures prices remain elevated. The disconnect isn't irrational, it's operational. Who feels this next? Collectors and long-term holders often don't. If you already own silver and aren't forced to transact, none of this requires action. But short-term traders, scrap sellers, and anyone expecting immediate liquidity run into a different reality than the screen price suggests. At a broader level, this highlights a recurring misconception. Market deficits describe annual balances, not day-to-day flow. A deficit can coexist with local surpluses, especially when the form of the metal doesn't match what the system is currently optimized to process. This is why headlines alone are unreliable. A projected deficit doesn't guarantee smooth distribution, and visible piles of silver don't disprove tightness elsewhere. The market isn't a single container, it's a chain. Right now, that chain has a kink in the middle. None of this implies a collapse, and none of it implies an imminent price surge. It simply explains why different participants are experiencing the same market very differently at the same time. Understanding that difference is the edge, not predicting tomorrow's price. The current setup feels unfamiliar, but it isn't without precedent. In previous cycles, stress in the silver market has rarely started with price. It usually began with processing or distribution. The most comparable moments weren't the peaks themselves, but the periods before them, when something small stopped working smoothly and nobody paid much attention. In the late 1970s, well before silver prices accelerated, refiners and wholesalers struggled with throughput as demand shifted faster than infrastructure could adjust. In 2008, the issue wasn't a lack of silver in existence. It was the inability to move it efficiently. Coin shops couldn't source product even while vault inventories technically existed. In 2020, the disruption came from shutdowns and transportation bottlenecks, not geology. The common thread wasn't running out of silver, it was timing mismatches. What happened before prices reacted was a buildup of friction, delayed settlements, inconsistent premiums, and growing gaps between paper prices and physical availability. The market didn't break, it hesitated. And that hesitation changed behavior long before charts reflected it. What's different this time is the form of the bottleneck. Previously, disruptions were broad: logistics, mint shutdowns, financing stress. Today, the constraint is more selective. Fine silver continues to move. Alloyed silver slows. That distinction matters because it splits the market into parallel experiences instead of one unified narrative. Another difference is visibility. In past cycles, much of the stress was opaque to retail participants. Today, information travels instantly. Dealers talk publicly. Inventory photos circulate. That transparency reduces panic, but it can also blur interpretation. Seeing silver everywhere doesn't mean it's in the right place, in the right form, at the right time. History helps here, not by predicting outcomes, but by filtering emotion. When similar frictions appeared before, the market eventually adapted. Refiners expanded capacity, incentives changed, material flowed again. But the adjustment phase was uneven, and those who assumed the screen price told the whole story were often the most confused by what they encountered on the ground. So the lesson isn't that silver must rise or fall or repeat any prior move. The lesson is narrower. When market mechanics change, reactions lag. And the most important signals tend to show up in behavior, how people transact, before they show up in price. That's the context worth remembering. This is where most commentary goes wrong, by treating one outcome as inevitable. Markets don't move on certainty, they move on conditions. So instead of asking what will happen, the better question is, what would have to happen? Below are 3 clean scenarios. None are predictions, each is conditional. Bull case, conditions tighten further. If refining capacity remains constrained longer than expected, and if retail demand for fine silver continues at current levels, and if dealers remain cautious in buying alloyed silver due to cash flow risk, then physical premiums could remain elevated even without aggressive price appreciation. In this scenario, strength does not come from panic or speculation. It comes from persistent friction. Fine silver stays liquid. Alloyed silver stays slow. The market adapts by favoring what moves easily. Importantly, price wouldn't need to surge. A stable or moderately higher spot price combined with limited physical availability could still feel tight to participants on the ground. This scenario requires no new macro shock, just time. Base case, gradual normalization. If refiners catch up on backlogs over the coming months, and if settlement timelines shorten toward historical norms, and if price volatility compresses rather than expands, Then the current dislocations fade quietly. In this case, alloyed silver begins moving again. Not all at once, but incrementally. Dealer bid prices improve. Cash flow pressure eases. The market resumes its usual rhythm. This is the most common outcome historically. Bottlenecks resolve not with headlines but with boredom. No breakout, no breakdown, just fewer phone calls about delays. Prices under this scenario may drift within a range, reflecting broader macro forces rather than internal silver mechanics. For long-term holders, nothing changes. For short-term participants, conditions simply become more predictable. Stability, not excitement, defines the base case. Bear case, demand softens into the bottleneck. If retail demand weakens meaningfully, and if price declines while settlement delays persist, and if dealers are forced to protect balance sheets aggressively, then pressure shifts from logistics to valuation. In this environment, the bottleneck becomes a liability rather than a curiosity. Dealers reduce bids further. Some categories effectively freeze. The spread between what sellers expect and what buyers can safely pay widens. This does not require a collapse in silver's long-term fundamentals. It only requires a mismatch in timing, falling prices combined with slow exits. The bear case is less about silver being unwanted and more about nobody wanting to hold risk while waiting. Liquidity dries up first. Confidence follows later. Putting it together. Notice what none of these scenarios rely on. Bold price targets, dramatic narratives, or single-event catalysts. They hinge on process, not drama. Which path unfolds depends on how quickly the system clears friction, and whether demand stays patient while it does. That's why professional risk management doesn't anchor to one view. It tracks conditions, adjusts exposure, and stays flexible. When markets get noisy, I narrow the lens. Not to predict, but to avoid being distracted. First, liquidity, not price. I pay attention to how easily transactions clear. Are dealers widening spreads or tightening them? Are settlement times shortening or stretching again? Liquidity problems surface there first, long before they show up in headlines. Second, the US dollar index, DXY. Not because silver mechanically trades inverse to the dollar, sometimes it doesn't, but because dollar strength or weakness changes funding stress globally. A rising dollar can quietly pressure inventories and leverage, even if silver prices hold up. Third, treasury yields, especially the real yield component. When real yields rise, holding non-yielding assets becomes a harder sell at the margin. When they stabilize or roll over, pressure eases. I'm not looking for dramatic moves, just direction and persistence. Fourth, inflation data, CPI and PCE, but only in context. One print means very little. What matters is whether inflation expectations are drifting, anchoring, or breaking trend. Silver reacts more to changes in expectations than to the absolute level. Fifth, volume and open interest in futures markets. Expanding open interest with stable prices tells a different story than rising prices on shrinking participation. One suggests commitment, the other suggests exhaustion. Neither is bullish or bearish by itself. It's the combination that matters. Finally, I watch behavior. Are people asking about delivery or just price? Are they buying specific products or anything available? Behavior answers questions charts can't. This isn't a checklist designed to produce a signal. It's a dashboard meant to keep me honest. When multiple indicators align, I pay attention. When they diverge, I slow down. That discipline matters more than being early or loud. None of this requires urgency. The silver market isn't broken, it's adjusting. And adjustments are rarely dramatic when you're inside them. They just feel uncomfortable. If you're managing risk, the goal isn't to guess the next move. It's to understand what conditions you're operating in and size decisions accordingly. Patience isn't passive here. It's a strategy. Some phases reward action, others reward restraint. Knowing the difference is most of the work. This isn't investment advice. It's simply how I'm reading the market right now, based on flow, incentives, and experience rather than headlines. Stay flexible. Stay liquid. Let the market show its hand before you try to play yours.